over any other areas of the income tax law when it comes to registered emission units. They are not trading stock, and they are also not subject to capital gains tax because Division 420 takes precedence. In addition, the taxation of financial arrangement rules do not apply to registered emission units. So that's something to be mindful of as well. In terms of the tax consolidation impacts, like all other assets, they are treated as assets of the head company. So if you acquire an entity which is has registered emission units, they are treated as reset cost-based assets, but the tax cost setting amount is subject to is sort of limited to the greater the market value and terminating value. In terms of the stub period, so if a subsidiary is acquired partway through an income year, there is no opportunity for that subsidiary to revalue their REUs. It's just taken at the value of, I believe, at the beginning of the year. So there's no. It doesn't allow you to revalue those units before you enter the tax consolidated group. The valuation choice of the head company takes precedence. So if the head company already has units and it has elected a method, that subsidiary is also required to use that method going forward. But once it leaves the tax consolidated group, it can choose its own method upon exit. That comes to the end of John and myself presentation. Are there any additional questions that you'd like to ask us?
In terms of percentage, do you have any idea of the cost impact on common man due to carbon tax?
Sorry?
In terms of percentage,
yes.
Do you have any idea of the cost impact of carbon tax for the common man?
No, I wouldn't know that, sorry.
Can I just request for people who are asking questions, if you can just mention the name and the organization they come from? I think there's one question. Not. Is it? Okay. Is it any better now? Little? Furthermore? Still better? No? Yes? Yes. Okay. Oh, okay. Sorry, there was some confusion. We thought there was a question from there, but the other issue was the sound. So, is there any other question that I think we have a question from here, Anthony?
Hello. Just trying to understand the substance of this whole scheme. It looks like an asset of some sort, units. You buy it and you keep it, and you sell it, make money, pay tax on it. What is the real benefit to whoever is selling this unit? Is the government giving free, or what is happening?
What is the real benefit of selling, or?
No. Not the people who are buying or selling, but
yeah.
Who is selling to begin with, or what is the substance of this whole scheme?
Well, I guess under the carbon initiative, you have certain you may emit more than you're required to. So you have to give up units that you've acquired to meet that carbon shortfall. So.
But you're not consuming those units. You're buying, and selling.
Yeah, you're buying and selling to basically meet your carbon tax obligations.
But it's not an expense for me. Like if I have a company, I'm buying units, keeping it in my assets, and selling it when I want to sell it. Mm-hmm. So I'm not putting any expense in my P&L. Mm-hmm. So what is the point of buying them?
Well, you're still, for tax purposes, I mean, this is just for tax purposes. In terms of the actual purpose of buying and selling, I'm not the carbon tax guru, but the tax consequences are you are allowed a deduction and for acquiring those units under the legislation, and when you sell it, you're required to return tax on that. So I understand there might not be actual purchase per se, but I don't know.
But it doesn't look like any maintenance cost involved to those units. Like if I buy a unit, do I need to pay X dollars per unit per month or per year so that I say
that goes back to the mechanics of the carbon tax, and that's sort of not an income tax issue. So I'm not sure how to answer that question.
Yeah. I was just going to say, so the carbon tax as Sabu mentioned earlier, it's really about trying to reduce the amount of carbon that's emitted into the atmosphere, putting an economic penalty on those companies who are doing it. There are these carbon permits to help companies transition into that process. And that's driving this this additional market which will occur. I mean, you're ultimately best placed to decide whether you want to buy or trade if there's a benefit there. But it's one of the flow-on effects of having the carbon permits out there. Yeah.
What I'm trying to understand or struggling to understand is it's like some new kind of investment for me. I'm not losing money by buying these. It has a value which I can sell later on, maybe at a profit. So where I'm helping the environment by purchasing these, more of a holistic question than tax or financial question.
I think the benefit to the environment is at that early stage about the companies paying the tax and then getting the permits, which is then driving the trading. Yeah.
We have got one more question, I guess the last one.
Question exactly. See, what I understand, government is trying to create an asset which is being traded in the market, okay, so that people buy and invest into that asset so that that asset can be used for carbon emission. It's like building any other infrastructure. So everybody is, when you buy a stock, you're actually funding that stock at the same time. So if it becomes popular, so more and more investment might happen on that. As this is what I think is the purpose. Yeah. Thank you.
Thank you.
Yeah. Thanks a lot. Thank you, Mahesh. Thank you very much, John and Anthony. Just have something. If you can just stay. Yep. Can I request our sponsors, or one of our sponsors, Trustee, to just come on stage, Mr. Vinay Kumar and Mr. Himanshu Soni, to give away token of appreciation to Anthony and John. I think we have just one. I think this has been a trend since morning, actually. So if you can just come this way, guys. Yep, that's a good idea. Yeah. Thanks, guys. Yep, and there's one more for John.
Thank you very much.
Thank you, John, and thank you, Anthony. Just wanted to kind of apologize, John, for that technical glitch. I guess any success of a function, you do have a little bit of that, but it was not intentional, I can promise you that. As I mentioned earlier, we'll get everyone, all the participants, the presentations in the form of a web link which we'll be sending out, which will have a link wherein you'll get access to all those presentations.
Excuse me.
Sorry.
And what also I suggested to John is maybe we can do a separate CPD session on this topic. It's a very interesting topic and very complicated too. So maybe in the new year we'll have a separate session for that.
Yep, that's a good idea, Shantanu. So just to kind of mention one thing again, that we obviously are supported greatly by our sponsors, Austin Brothers, Bank of Queensland, Bella Vista, Macquarie Private Health, Risk Wisdom, Sumo Global, and Trustee. So whenever during the breaks, if you can visit the stalls, I'm sure you'll gain a lot out of that. And not only for this conference, but they've been supporting us throughout the year. So really want to thank them. So please, your hands together for them. So, talked a lot on the sponsors. Now we'll move on to the next topic, which is transfer pricing. So, I've just missed my paper, sorry. So as you might probably know, transfer pricing is one of the most important aspects of international taxation. It is a core aspect of taxation across different countries with different laws, rules, and regulations. And if you are part of a multinational enterprise and have international dealings with other associates or branches with the multinational enterprise, you may have transfer pricing considerations. Where countries have double tax agreements, transfer pricing substantiations and considerations will need to be done. double tax agreements are entered mainly to avoid double taxation and fiscal evasion, and also to foster cooperation between the two countries. Australia has entered into taxation agreements with more than 40 countries. Transfer pricing regulations exist in countries to prevent profit shifting arrangements, and they mandate that international dealings are at arm's length between two or more associated enterprises. The purpose of Australia's transfer pricing rules is to counter the underpayment of Australian tax. This requires businesses to price related party international dealings according to what truly independent parties acting independently would reasonably be expected to have done in the same situation. Pricing for international dealings between related parties should reflect a fair return for the activities carried out in Australia, the Australian assets used, and the risks assumed in carrying out these activities. Pricing that is not in accordance with Australia's transfer pricing rules is often referred to as international profit shifting. Methods of setting prices and reviewing the outcome of international transactions with related parties are recognized internationally using the arm's length principle. And Australia has adopted these in taxation rulings to help business understand what is expected of them. The internationally accepted arm's length methodologies are based on comparing the outcomes of related party dealings with the same or similar dealings of independent parties. The concept of comparability is central to the arm's length principle. Recently, there have been considerable reforms in transfer pricing within Australia and across the globe as well. Ashish Dave, who is our next speaker, will be presenting on the transfer pricing reforms currently happening and will brief us on what to expect in the years to come. So just a brief on Ashish. Ashish is actually a very good friend of all of us, and he's been helping the chapter grow considerably in the last few years. Ashish is a director with Deloitte Australia's transfer pricing group. He has more than 9 years of transfer pricing specific experience, including comprehensive transfer pricing planning, compliance and risk analysis, and has successfully completed a wide range of bilateral and unilateral advanced pricing arrangements. Ashish has developed extensive experience working with several large global energy and resources, technology and media companies on a variety of transfer pricing and economic analysis projects. Ashish will be presenting on the current reforms in transfer pricing and how it impacts the compliance in the coming years. So please welcome Ashish Dave.
Thank you, Subbu. First of all, I'd like to thank CA Institute to give Deloitte, me, and my colleagues an opportunity to present here, and a very warm welcome to all of you from Deloitte. There's a lot to cover in today's presentation, but I'll thank Subbu first of all because he has covered a bit of my presentation already today. So you all know what background of transfer pricing is. Let me start with asking you a very quick question. So who all from here have been previously involved in transfer pricing, with a quick show of hands, just for me to know? All right, so that's a good sample here. Transfer pricing is going through huge reforms in Australia. The reforms, for the first time in 30 years. In 30 years, which is a long time, Australia was one of the first countries to introduce transfer pricing rule in its domestic income tax legislation, which was after OECD guidance. First OECD guidance on transfer pricing was issued back in 1979. Australia introduced its transfer pricing rules in somewhere around 1986-87 in the domestic tax rules. In the last 10 years or so, most of the countries in Asia-Pacific region have introduced transfer pricing rules, and it's a key rules. So we mentioned it's an anti-tax avoidance, supporting tax governments, income tax offices to avoid erosion of tax base. Primarily, that's the intention. India introduced transfer pricing rules in 2001, and I was one of the key members from Deloitte who represented the ministry then with some of our partners in Deloitte Australia here to establish and explain the CBDT, as we call in India, Central Board of Direct Taxes, to help them understand why transfer pricing rules are so relevant to be introduced. And that was one of the reasons why government decided to introduce transfer pricing rules then. So we're going to talk about transfer pricing reforms in Australia here and changing disclosure requirements. Okay. There's a fair bit to cover. As I said, we'll talk about transfer pricing environment in Australia, what triggered that change. Can everyone hear clearly if I move away from? All right. So we're going to talk about what triggered that change, why it's changing. We're going to talk about SNF Australia's case, which was the first ever transfer pricing decision given by Australian full federal court. We're going to talk about what those reforms are. They are retrospective and prospective. Retrospective goes back as far as 1st of July 2004 and may have a huge ramifications for multinational companies operating in Australia. We'll also talk about ATO's approaches in conducting transfer pricing reviews and audits, and what are typical pitfalls. We'll talk about some practical aspects of that, and what are red flags. So what are the indications that ATO looks for in the income tax return when they are lodged to identify what tax is at risk and which taxpayer represents those risks for selection them for the review. And then we'll conclude with some concluding remarks as to what taxpayers should be doing going forward as a result of these reforms. So as I said, current transfer pricing rules are 30 years old. If you see Income Tax Act as of now, Division 13 has transfer pricing rules, and there are only few pages in the Act that relates to transfer pricing, barely 3-4 pages, but hundreds of pages of guidance issued by the ATO to help taxpayer monitor their transfer pricing. Unlike in India, Division 13 or transfer pricing rules haven't been a subject of huge litigation. In India, most of the cases, most of the assessments are challenged to commissioner level, from commissioner to tribunal. We all know from tribunal to then High Court to Supreme Court takes 10 years, 12 years without resolve. It's improving, but in Australia until recently, transfer pricing rules were never challenged. They were never challenged. Why? Not because there were dearth of litigation, there were many litigation, but because taxpayers really didn't wish to invest the time and resources in going through that litigation processes. Most of the time, the litigations were concluded at a field officer's level through a settlement process or through agreeing an outcome as to what that taxpayer should be achieving in a go-forward basis. And typically, what do we call that in transfer pricing? We call as advanced pricing agreement, where taxpayer agrees with the ATO as to what the future outcome of profitability should be and give certainty to the tax office. So that's a reason that we haven't had in Australia so much of litigation. However, the recent case, which I'll refer to shortly, highlights some problems in the transfer pricing rules in Australia, and which triggered the reform process. And the issues were that Division 13, as we call it, transfer pricing rules, highlighted on the pricing of the cross-border transactions, right? So if we go back to history and see ATO's approach in determining an arm's length pricing of intercompany transactions, they always looked at profitability, okay? Because that's where they get the tax from. So ATO has gone about auditing taxpayers, saying, well, you're not achieved profits from your operations in Australia. I'll take a simple example of importer and distributor. You have been operating in Australia as a subsidiary of a multinational parent, for example, in the US, and you made consistent losses, 10 years, 11 years, 15 years. Why are those losses? And because there are losses, there's this assumption going on that perhaps your purchase price of products coming in from related parties are not priced properly. It's non-arm's length. And that's resulting into losses. Division 13 did not give ATO that power to look at profits, but ATO applied that in making audits and assessments. ATO always believed that that power they have under Australian tax treaties. Tax treaties do refer to profitability. However, as we all know, I mean, this is the area of litigation. What are tax treaties for? Tax treaties negotiated are not generally to impose a tax, but to mitigate double taxation arising as a result of implementation of the domestic law. ATO thinks differently. So that's the area of potential problems. We'll talk about that. So a couple of years ago, 2010, this brave taxpayer SNF Australia did challenge the ATO's transfer pricing rules. They challenged the transfer pricing rules. They went into federal court. They won the decision. ATO dismissed the appeal. Let's go through this case. So the simple fact pattern here, we've got a subsidiary of this company in Australia, parent company based in France. Okay. It's a chemicals company. I mean, I'm not sharing any confidential information here. As a matter of fact, it's in public domain. You can go and Google it. Everything is available there. It's a subsidiary distributor of a French company. Australia, they purchase products from their parent company across the world, from manufacturing entities in France, in US, in China, and distributed the products to customers in Australia. Yeah, so it's an importer distributor, a classic case, importer and distributor. So what happened? They achieved consistent losses for 11 years. Yeah, 11 years. ATO didn't like it. And they said, well, you've been operating for 11 years, you haven't paid a single dollar of tax, pricing are wrong, we'll adjust your pricing. We've got a set of methodologies that we go through typically in a transfer pricing. One of the methods is profit-based method. We call it transactional net margin method. So let's not go into technicalities, let's call it net margin method. So ATO applied that net margin method and argued that the reasons for the adjustments is the poor bottom line profitability, okay? Adjusted the profitability to bring them back into profits. And by doing that, what essentially they did was they reduced the purchase price of the products. That's the connection from transfer pricing perspective, right? So SNF said, show us in Division 13, show us in transfer pricing rules. Where do you have that power to do that? We don't think you have got that power. And we're not convinced that tax treaty gives you that power. Interestingly, ATO has been arguing that they've got power under tax treaty to make adjustments based on profits, but they were never challenged in the court. This was a great opportunity to do that. They didn't challenge that. They didn't bring that in the court. There were some references made in the court, but it was not discussed on a substantive level. What SNF did was, in this case, they presented why they believe that the adjustment should not be made, because they thought that the pricing was reasonable, and they provided evidence to support the pricing. They said, we're purchasing products from China, US, France, and these manufacturing entities, which are part of our group, they sell same and similar product to independent third parties. No connection whatsoever with the group. It's a global market. Products are globally available. And compare the pricing. They provided that evidence to the court. And argued that the pricing is reasonable, but that's not the reason for losses. So what's the reason for losses then? SNF argued there are commercial factors. I mean, the losses can't be just a result of purchase price of products. It is a broader than that. It's a business, and business goes through ups and downs. What does that mean? That means that there's poor management, bad debts, turbulence in the market, and they were able to demonstrate those points. And the court agreed with that argument. court said, yeah, makes sense. You're operating in a competitive environment. There could be commercial rationale, and local commercial rationale for consistent losses need not necessarily be as a result of non-arm's length pricing. And the court dismissed ATO's appeal. Now, it's a favorable decision from a taxpayer's perspective, very favorable decision. The issue from an ATO's perspective is that there got 40 plus audits in the pipeline where they have taken a similar position. Now, what are we going to do with it? There's roughly around 1.9 billion worth of tax at stake. It's a big thing. How are we going to support this? Federal court has given this decision. There's nowhere to go from here. Well, we've got one option, change the law. So a result of this decision was a change in law, but there were also compelling other reasons why Treasury and the ATO embarked on a reform process. It's because ATO's transfer pricing law has been 30 years old. The world has moved on. OECD guidance, OECD has issued new transfer pricing guidance in 2010. It's quite a bit of change from the previous guidance. And the ATO wanted, and Treasury wanted, transfer pricing law to keep pace with the reform process going on around the world, including transfer pricing. So this was a trigger, but there are broader reason for reforming the transfer pricing rules. This is just a practical example, I thought, how it works in a live scenario. And we come across these cases so often where you see a distributor or manufacturer or service providers or companies that we as in Australia, we are an inbound economy where most of the companies purchase products for distribution. We see less of assembly and manufacturing operations here. This is a classic example. You see the gross margin for each of the years in this particular tax place, very healthy gross margin, 25, 28, 30. Now, operating expenses are high. Now, if we say the gross margin is 30, 28, and 25, and the cost of goods line is above that, well, yeah, I mean, losses is a concern, but doesn't it say anything? Well, they're making good gross profit. Pricing of products can't be a sole reason for losses. What's happening at operating expense level? Why are they so substantial? And that's what they argued, and that's what taxpayers now are considering to argue in all the cases with the ATO to explain what's happening there. And the short window where taxpayers are very happy. Well, we've got a case now here, but not necessarily. I mean, ATO is in the process of reforming, and what are those reforms? So ATO embarked on the reform process late in 2011, November, when it was announced that they intend to change the transfer pricing rules, and the reform process will have both retrospective and prospective application. Okay. So retrospective application would mean that ATO is seeking power that they believe they have under the tax treaty to make transfer pricing adjustment based on profits into the domestic law, right? Into the domestic law, and it will have a retrospective application. Retrospective application, and this is one of the most controversial part of the reform. Retrospective application goes back to 1st of July 2004. Okay, and we'll talk about what does that mean. The ATO and the Treasury have argued that this is not a change in the rules. It's not change in the reform. It's clarification. It's a clarification because our approach has always been that treaty gives power to the ATO to make transfer pricing adjustment based on profits. We're just clarifying that by bringing the power that they have under the tax treaty into the domestic law. And that's the clarification. So it has retrospective application, and it applies to treaty cases, because if you have no treaty, then there's nothing to bring for those countries with whom there's no treaty. There are not many of those, but it applies to treaty cases. And we'll talk about what does that mean on a practical level. And then there's a prospective changes that they will replace the current transfer pricing rules in Division 13 Income Tax Act with a brand new transfer pricing rules, which will have a go-forward application. So they were in phases. Retrospective application, first phase, which has been enacted. It's in the transfer pricing law. It's in the Income Tax Act. And the prospective changes, hot off the press. The exposure draft was just released yesterday afternoon. As Deloitte, we've been involved in the consultation process with the ATO. So